How much longer will the stock market crash last? Today, the sell-off continued. The NASDAQ finished the day down 1% after actually starting the day very, very green. This means that over the past 5 days, the NASDAQ's basically down 8%. Over the past month, it's down 12.5%. And from its record high that it set on July 10th, it's now down more than 13.5%. This has happened in less than a month, and that's kind of crazy to think about. Now, it seems like on this YouTube channel, I'm the only one that gets to make these predictions, so I encourage you all to leave a comment down below. Let me know your thoughts. How long is this stock market correction going to last? And on your way down to the comment section, you might as well hit the like button and subscribe button. I don't know, it's just on your way. It's pretty convenient. But let's talk about this. In my personal opinion, I believe this stock market sell-off is much more technically driven than it is fundamentally driven. And you're not going to find very many other people that agree with me on this. Yesterday, I destroyed the unemployment data and the labor market data that people keep pointing to and the SOM rule. If you haven't seen that video, go watch it. I think it's the most important video anybody could come across today. I said that yesterday, and the feedback on that video has been very, very good. On this YouTube channel, I show you data that nobody else wants to show you or they simply don't know exists. That's how deep I go, and that's what gives us an edge in the stock market. But anyways, I'm going to back up my thesis here that it's technically driven, not fundamentally driven. Let's look at this. You know, on Monday, so 2 days ago, the VIX, which is the volatility index, spiked to actually over $60, which is crazy. It's only been that high like 3 times in history. Ever since then, it's kind of settled down, cooled off a little bit, which is good. And this sets me up for my first point. We can look at the VIX versus the high yield corporate bond spread. The chart looks complicated, it sounds complicated, but all you need to know is that usually these two items move in tandem with each other during market sell-offs. You can see on the chart how highly correlated they are. But on Monday, it was just the VIX. It was just the volatility index that spiked. The high yield corporate bond spread increased slightly. Basically, during market sell-offs, usually the high yield corporate bond spread widens because the higher yielding bonds actually end up yielding more as the threat of bankruptcies rise. You know, if the likelihood of bankruptcies rise, the investors demand a higher interest rate on the corporate bonds, if that makes sense. And we didn't see that. And this is the first thing that indicates to us that the markets aren't really worried about a recession, contrary to popular belief or the picture that most other people on the internet are painting. This indicates to us that the VIX unwinding, and that's a word I'm going to use a few times in today's video, is much more just a short squeeze where investors for years now have been able to short volatility or sell volatility, short sell volatility, and go long the markets and make a ton of money. And this works great until it doesn't. Of course, we had the yen carry trade start to unwind, and that's what caused the huge spike in volatility, which obviously if the markets are short volatility and volatility spikes, it's going to cause a massive short squeeze, not much unlike you see in stocks, individual stocks. You can see short squeezes, and it's kind of a snowball effect where after one short is forced to cover their margin call, it forces another to have to cover their margin call because they're buying back volatility, increasing the VIX. And to buy back the volatility and cover their margin call, they have to sell stocks or sell equities, which brings the equity markets down. This might sound complicated. I hope it doesn't. It's really not that complicated. And like I said, the unwind or the short squeeze of the VIX was caused by the Japanese yen carry trade unwinding itself. This also sounds complicated, but it's not. Basically, it's where investors borrowed yen at really, really low interest rates, and they used that cheap money to buy assets in other countries, whether that's stocks, whether it's the Magnificent Seven, whether it's NVIDIA stock in general, or maybe they're just investing that borrowed money into government treasuries or bonds and getting a higher interest rate. And that's called an arbitrage opportunity. Again, works great until it doesn't. All of a sudden, the Bank of Japan came out and said, oh, we're going to raise interest rates slightly. And obviously that strengthens the currency. And that's when you have the unwind and the short squeeze of the carry trade, because if the currency strengthens in relation to the US dollar, it forces those short sellers of the yen to cover their margin call. And to cover their margin call, they have to sell whatever asset they bought or interest-bearing instrument they bought, which causes a short squeeze, and obviously to cover the short squeeze, it means more and more people have to sell their net long positions to cover their short positions. Now, an important point I want to make here is you'll see on this chart, the red line is the yen per dollar. So this is the value of a yen. It bottomed on July 10th, which is actually when the NASDAQ peaked. You can see that on the blue line. What was July 10th? That's when the softer than expected CPI data came in and the markets gave the all clear to cut interest rates. So it's actually a very good thing that the hard landers didn't get their rate cut, because a rate cut in America would have made this unwind of the carry trade even worse. Now, there's not a lot of data out there actually to really see how much money is tied up in this carry trade or how much short interest there was in all of the volatility bearing instruments you can buy in the stock market. So I personally believe that this is going to be pretty short-lived. I think that the markets are going to find a bottom this week. I think I'm going to go on record, and I'll probably be wrong, but I'm going to say tomorrow actually is going to be a very green day as unemployment claims come in much below expected. And I think that's going to cause a new risk-on trade, or the risk-on trade to return, which is going to mean stocks, Bitcoin, whatever asset you have is probably going to be very green tomorrow. We'll see. We'll see. Come back to this video and see if I was correct. If you want another chart that shows us this isn't a recessionary sell-off and it's much more technical in nature, we can go back to the U.S. high-yield corporate bond and compare that to the 10-year U.S. Treasury bond. It's very similar to the last chart where usually if recessionary fears are rising, the high-yield corporate bond yield will rise itself. And obviously the U.S. Treasury bond yield will stay the same because that's kind of a manufactured yield by the Federal Reserve. Well, you can see there was a slight uptick, just a smidgen of an uptick, but you would expect much more of a spread here if these recessionary fears, if the cause of the market off was recessionary fears. The gray lines here in the chart are when recessions happened. And basically based on that, we can see that if the markets are worried about a recession or if a recession is currently happening, the spread between these two items is actually usually between 600 and 700 basis points, not 300 basis points or 400 basis points, which is where we're at right now. Now, I will say the one risk I do see potentially arising from this Japanese yen carry trade unwinding and the volatility index short squeeze is actually a negative wealth effect. If this does last long enough and the markets continue to sell down, it's going to have a negative wealth effect on people. I'm sure you all have experienced it. When your stock market portfolios, think back to 2022 when your stock market portfolio was doing piss poor. You had much less of an appetite to spend your money. And that goes for this can be an economy-wide thing. And it is something that could cause a recession if it gets bad enough. But again, I just think that both of these unwinds and volatility and with the carry trade are going to be very short-lived. And these are really the only two areas in the stock market where any short leverage existed. And it's just already getting wiped out. It's potentially already crescendoed. Now, to speak about unemployment briefly, this ties into yesterday's video, but it's something I forgot to mention. I kind of talked about it, but not as directly as I wanted to. You'll see this is a chart of the unemployment rate and different financial crises we've had in our economy, over the past, 75 years. And most of the time, you'll see that the unemployment rate rises or skyrockets whenever we get a financial crisis that occurs. We got a financial crisis to occur in March of 2023 when some regional banks failed. We had Silicon Valley Bank, several others that I honestly can't remember off the top of my head, but that was a legitimate concern. But the reason that I personally don't believe unemployment's about to skyrocket like it has in the past is because the Federal Reserve has learned how to play whack-a-mole with emergency liquidity facilities. Basically, they've learned how to do that as a result of the great financial crisis in 2008 and 2009, and also because of the great virus crisis in 2020. And we've just seen, I think, the Federal Reserve contain a financial crisis for one of the first times ever. They were successful in identifying this crisis. They were successful in containing that credit crisis and prevented it from becoming an economy-wide credit crunch and an economy-wide recession. So I think that's what's different this time. We've had a small uptick in unemployment, and I encourage you to go back to yesterday's video to really, we really dove into this deeper. But when we look at the data, and I show this in yesterday's video, the reason unemployment is going up is not because people with jobs are losing jobs. It's because people without jobs are entering the workforce. This is generally a result of immigration, and in particular, illegal immigration. And then also in the month of July, we had Hurricane Beryl make landfall in Texas. And we looked at how of the national unemployment claims, 87% of them came from the state of Texas in the month of July. 87% of the rise in the unemployment claims came from the state of Texas in the month of July. And that's something that a lot of bears or hard landers or people that say we need to cut rates now, they're ignoring, or they're just simply not aware of. And I think that's a really, really important part. I'm kind of weird. I'm a bull in the stock market right now, and I don't think we need to cut rates, and I don't think the Federal Reserve should cut rates. I believe they will in the month of September. I think it'll be a 25 basis point rate cut, but I don't think they will until 2025. And, the markets right now are pricing in 8 rate cuts over the next 12 months. I don't think that's going to happen. At the beginning of 2024, the markets were pricing in 6 or 7 rate cuts, and I said the same thing back then. I don't think it's going to happen, fellas. And look at this. We're in the middle of August, and we've yet to see a single rate cut this year. So I think that's going to be a very similar thing that plays out. And it's because the labor market and the economy, both of them are deceivingly strong right now. And we actually got some economic data that I'll get into now. We got the updated SLOOS. So this is the Senior Loan Officer Opinion Survey. This basically is a survey where they ask loan officers around the country a list of questions. And this chart on the screen here shows you the percent of respondents that are tightening lending standards. You can see at the beginning of 2022, when the Feds first started to raise interest rates, that's when loan officers and banks really started to get more conservative or concerned or tighten up lending standards. You can see that's the big uptick you see right here, the big trough and bottom, and this big uptick. But you'll notice ever since basically the second half of 2023, the amount of banks tightening lending standards has been falling off of a cliff. This is not something you typically see in a poor economy or when we're in a recession. And the banks were actually most cautious. That's what this last big bump here in these lines was during March of 2023, during that small financial crisis where Silicon Valley Bank failed and a few others also failed. And you can also see on this chart that lending conditions tightened to levels similar to previous credit crunches that we saw in the economy. The great virus crisis, the great financial crisis back here. And then if we zoom out in this chart even further, it's not on the screen here, also during the dot-com bubble, lending standards were getting very tight as well. But again, this time is different. Usually it takes the Fed easing policy for banks to actually start to loosen lending standards. This time, they've started to loosen lending standards before the Fed has even cut rates. That's crazy to think about. So when I say this time is different, sure, those are dangerous words, but all of the data I presented on this channel so far in 2024 has been telling this story of how this time actually is different. And so far, we've been 100% correct. And then this chart here is from the same survey, the SLOOS, and this question asks lenders if they're seeing an uptick in loan demand. It's pretty evident that demand for loans or demand for borrowing is actually coming back. We can see this very clearly on this chart. And again, you don't see this in times of recession or when a recession is about to hit. You see this when the economy is very strong and continuing to grow, actually. And that's what I'll show you next. It's very early, but we got our first GDP estimate for Q3 of 2024. This is going to be revised several times, so don't write this number in Sharpie. But the first estimate is that GDP in Q3 is going to grow at 2.9%. That is up another basically half percentage point from Q2's GDP growth. So the economy, based on what the Atlanta Fed is seeing, continues to grow. And again, I'm just miffed by all of these influencers online that think we're in a recession or we're about to enter a recession. And one last note before I get into the stocks I'm actually buying. I think this is something that bears have also missed since, they started to cry recession several years ago. The banks now only hold about 35% of the total private sector debt outstanding. This is down from basically 55% in the 1980s, which is crazy to think about. And I should say the reason I'm bringing this up is because bears have gotten the sluice data so wrong. They've pointed at it in the past and used it as a recession indicator or a bear market indicator, and they've been incorrect, basically with everything they've pointed to. But this is just another thing they were pointing to that I don't think they had the right data or conclusions drawn. But this is a big deal because if the banks hold less of the private sector's debt, it means that our economy is less interest rate sensitive than it used to be. And I've talked about on this channel in the past how the goods and services sector of our economy have basically flipped each other, where services make up 2/3 of our economy, whether that's consumption, employment, production, or even investment. 2/3 of our economy today comes from the services sector. That is up from 1/3 in the 1950s. And the goods sector has done the opposite. In the 1950s, it made up 2/3 of our economy, and it's down to 1/3 of our economy. And obviously, in the services sector, it is way less reliant on debt to grow or fund a business, or even for consumers to buy that service. Whereas with a good, a lot of times you're dependent on debt for all of those things. If you want to get more granular with this, private credit has picked up a lot of the slack here, and that's been very, very good for the debt markets in our economy, because when it comes to private credit funds, the funds they get usually come from long-term investors, whether that's from pensions or endowments. The reason that's a big deal is because when you get your funds from a pension or endowment, these are long-term investors. So these funds don't walk out the door like uninsured bank deposits might or can and even have in the past. And that's actually been the root cause of recessions previously, is people withdrawing money from the banks when something recessionary happens. Private credit also tends to have longer term deals that are based on floating rate debt. And because of those longer term deals, there's always lots of what we call dry powder available, because you have funds that are technically committed to funding projects or to funding consumers or businesses, but maybe it's not invested yet because it's a long-term project. But anyways, yeah, I don't know what people are seeing when they say the economy is in bad shape and we're entering a recession and we need rate cuts now. In fact, if we had rate cuts, it would make the unwind of the Japanese carry trade worse, and probably the volatility index, it would cause that to spike again, which would not be good for the markets. And it actually is usually the people that think we have to have rate cuts to have a bull market continue that are calling for rate cuts right now. And I don't think that would happen if we got rate cuts. I think the markets would actually fall because of the things I just talked about. But anyways, let's talk about the stocks that I'm actually buying, because clearly I don't think this sell-off is going to last long. And for however long it lasts, I think it's just a great buying opportunity. I have to mention, I give priority access to my paid monthly members. I'm entirely independent and self-funded, so your support means a lot to me. If you choose to be a part of that monthly membership, you can consider joining by hitting the join button located right next to the subscribe button, or you can hit the Patreon link in the pinned comment. If you don't get alpha in the stock market from a membership, I have a 100% refund policy, and I have yet to have to refund anybody. So let that speak for itself. I'm pretty confident in being able to, give you that value. And in fact, maybe you've heard me talk about this A list of companies that I'm putting together, of stocks I'm buying and I'm giving to my paid monthly members. I released stock number 3 today, and they had a blowout earnings, and that stock is already up 15% as of this recording. So don't miss out on stock number 4. That's all I'm going to say. I personally believe most of the opportunity will be found in small cap or mid cap land. I merged those two together and call them SMID caps. Might be cringy to some of you. I don't know, but that's just what I call them. The reason I think this is because the smaller the company is that you're looking at, the more sensitive it is to the economy and interest rates. It's a known fact at this point that the federal funds rate is going to come down. The Federal Reserve has basically told us they're going to be cutting interest rates. That will be a direct positive impact on these smaller companies that are much more interest rate sensitive. I also think that long term, the trend will actually be interest rates coming down rather than interest rates going higher, as long as we don't have a rebound of inflation, which could be caused if you cut rates too soon, too much. But I don't think that's going to happen. I think we have a good chairperson at the Fed right now in Jerome Powell. It has been an absolute disaster to own small cap companies over the past 2 or 3 years because of interest rates rising, but also because of the effects interest rates rising has on investors' mentality when it comes to investing in companies. If interest rates rise, investors naturally think that the odds of a recession are also increasing, which I already said, the smaller the company is, the more sensitive they are to the economy, which means it was kind of a double-edged sword. Interest rates rising, risks of recession rising in investors' minds. Why would I own small caps and mid cap companies? And it was a fair point. If you have stayed out of small cap companies, you've done very well for yourself. But I think this is about to change because interest rates are coming down. I think a lot of these companies have been grouped together and punished equally when I don't think that's fair. I think there are tremendous opportunities in some mid-cap land, and we've already found 3 of them, and I have a lot to go. So again, join the membership. But there are tremendous companies in this territory with tremendous business models, tremendous financials, much more cash than debt, growing revenues at 20% plus, growing incomes and profitability at much more than 20%. Those are the opportunities I'm after right now. And in fact, all 3 of the companies I've mentioned and I put on that list, their market caps are lower than the revenues they've delivered over the last 12 months, which doesn't make much sense when all 3 of these companies are either profitable or they're on the edge of profitability and will be profitable within the next 6 months. And we can also look at what Wall Street analysts are saying about earnings growth at companies. For the first time in a long time, the Magnificent Seven or big tech, they're actually on a slowing growth trajectory, or they're projected to be on a slowing growth trajectory over the coming couple of years. And for the first time since 2021, small cap companies and mid cap companies are supposed to outpace the large caps in earnings growth. That's a major shift in what's happening in the stock market. And I think as more investors start to realize that, and as it really starts to play out, they're going to shift their money into these small cap and mid cap companies. You have to remember in the stock market, you actually want to be too early to what you're investing in because that means you beat everybody else to the punch. You beat everybody else to the chase. And when they buy into what you've already bought in, that's when your capital gains come because the value of your assets increase. Since the middle of 2022, we've been very successful at doing this on this YouTube channel. You can go back and look at my videos. I mean, it's been kind of outstanding, honestly. So I'm not trying to toot my own horn. I'm actually saying that I'm probably due to be wrong. So I'll use this time in the video to say I'm not a financial advisor. I don't have a crystal ball. I don't know exactly what's going to happen. I just have an educated opinion on what's going to happen. And yeah, so don't sue me because I don't hit the buy button or sell button for you. You do that yourself. I made a public video about the first 2 stocks I've been buying. If you want to go watch that video, hit the I in the top right-hand corner right now. It'll open a new tab. The first one was Flux Power. This is a $50 million company. This is honestly a microcap stock. And the second one is not very dissimilar. It is One Stop Systems. It is also microcap, a $44 million market cap on it. So both of these were very small companies. The one I just released today is a little bit larger of a company, but I think all 3 of these are tremendous opportunities. I could explain to you why I'm bullish on these 2 in today's video, but I've already done so. Just go watch that video, and I don't want to waste too much of your time today. If you made it this far into the video, thank you so much. It means the world to me that you guys are still listening to me, I don't know, for 20 minutes or even longer than that into this video. But again, don't forget to comment down below what your thoughts are on this stock market sell-off, how long it'll last, if you're buying right now, if you're selling, let me know. And on your way down, hit the like button and the subscribe button. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.